More than 1 million households are set to renew their mortgage this year, according to the CMHC, Canada's national housing agency. And the Iran war, along with the changing rhetoric around it, are causing big changes to mortgage rates.
We've seen bond yields really spike up in the last few days, although it's like a roller coaster. Every tweet seems to move things.
Fixed rate mortgages are based on Canadian government bond yields, which move in lockstep with the broader bond market.
We've probably seen fixed rates go up by at least a quarter percent, kind of right across the board from all the lenders.
Investors are nervous about the spike in energy prices, even though the International Energy Agency, the IEA, is set to release a record 400 million barrels of oil reserves in an effort to stabilize crude prices.
High oil prices leads to inflation, which leads to higher prime rates, which leads to higher mortgage rates.
But reserves are limited, and if the war persists, this unprecedented emergency measure can only do so much.
Those emergency reserves are not going to last more than a few months.
Variable mortgages aren't immune. Suddenly, the potential for a rate hike or two from the central bank is on the table this year. If inflation gets out of hand, the Bank of Canada will need to intervene with higher rates.
When inflation heats up, central banks step in and raise rates to get people to start saving rather than spending, stop borrowing, and pay their debts down.
And that raises the cost of variable rate debt, including car loans and mortgages.
Given that cost of living and affordability issues continue to be the number one concern for many, many Canadians who don't have a buffer, those higher interest rates could push them to the brink then where they could be forced selling their home, or in order to keep their home, they might have to find even more economies in their day-to-day living.
Anne Gaviola, Global News, Toronto.